Dear viewers, I am your host Muhammad Asif Jaja and you are watching YouTube channel ETV 786. This channel is created and designed for business students. You are already watching basic concepts of accounting, business law, business taxes, business management on this channel, and now we are presenting business mathematics. Please view, like, share and comment the videos and subscribe the channel to view upcoming lectures. What is a loan? The term loan refers to a type of credit vehicle in which a sum of money is lent to another party in exchange for future repayment of the value or principal amount. In many cases, the lender also adds interest and or finance charges to the principal value. Loans may be for a specific one-time amount or they may be available as an open-ended line of credit up to a specified limit. Loans come in many different forms including secured, unsecured, commercial and personal loans. Loan process. The borrower may be required to provide specific details such as number 1, the reason for the loan, number 2, their financial history, and number 3, social security number or SSN, and number 4, any others. The lender reviews the information including number A person's debt to income or DTI ratio to see if the loan can be paid back, number B, the applicant's credit worthiness, number C, the lender must provide a reason for the loan application be denied, and number D, if the application is approved, both parties sign a contract that outlines the details of the agreement. And number E, the lender advances the proceeds of the loan, after which the borrowers must repay the amount including any additional charges such as interest according to the specified period. Terms of the loan. The terms of a loan are agreed by each party before any money or property changes hands or are disbursed. If the lender requires collateral, the lender outlines this in the loan documents. Most loans also have provisions regarding the maximum amount of interest as well as other covenants such as the length of the time before repayment is required. Reasons for the loans. Loans are advanced for a number of reasons including number 1, major purchases, investing, renovations, debt consolidation and business ventures. Number 2, loans also help existing companies expand their operations. Number 3, loans allow for growth in the overall money supply in an economy and open up competition by lending to new businesses. Number 4, the interest and fees from loans are a primary source of revenue for many banks. Types of loans. Number 1, secured loan. In these cases, the collateral is the asset for which the loan is taken out. So the collateral for a mortgage is the home, while the vehicle secures a car loan. Number 2, unsecured loan. Credit cards and signature loans are unsecured loans. This means they are not backed by any collateral. Unsecured loans usually have higher interest rates because the risk of default is higher than secured loans. Number 3, revolving loan. A revolving loan can be spent, repaid and spent again. A credit card is an unsecured revolving loan, while a home equity line of credit or HELOC is a secured revolving loan. Number 4, term loan. A term loan refers to a loan paid off in equal monthly installments over a set period. A car loan is a secured term loan and a signature loan is an unsecured term loan. Markup. Markup is the difference between an investment's lowest current offering price among brokers or dealers and the price charged to a customer for said investment. Markups occurs when brokers act as principals, buying and selling securities from their own accounts at their own risk, rather than receiving a fee for facilitating a transaction. Markups in a retail settings. Markups also appear in retail settings where retailers mark up the selling price of a merchandise by a certain amount or percentage in order to earn a profit. A pricing method whereby a retailer establishes a selling price by adding a markup to total variable cost is called the variable cost plus pricing method. Markdowns. Markdown occurs when a broker purchases a security from a customer at a price lower than its market value. Markdowns also occur when a dealer charges a customer a lower price for a security than the current bid price among dealers. Dealers might offer lower prices to customers in order to stimulate additional buying, which will offset their initial losses by earning them extra commissions. Reasons for price markdown. For retailers, a price markdown is a deliberate reduction in the selling price of a good. For seasonal merchandise, the retailer may be eager to clear the shelves of old merchandise to make room for the next season's goods. Some manufacturers may come out with new models of products each year or every few years, in which case they will offer markdowns on older products rather than risk being stuck with obsolete inventory. Markdowns and disclosure. It is important to know that financial firms do not have to disclose markups and markdowns in principal transactions, so an investor can easily be unaware of the price difference. A principal transaction occurs when a dealer sells a security out of its own account and at its own risk. An agency transaction occurs when a broker facilitates a transaction between a customer and another entity. What are taxes? A complete lecture on business taxes may be viewed on the channel. It will take only 20 to 25 minutes to understand what taxes are. What is a discount factor? In financial modeling, a discount factor is a decimal number multiplied by a cash flow value to discount it back to its present value. The factor increases over time, meaning the decimal value gets smaller. As the effect of compounding, the discount rate builds over time. Discount factor formula. The formula for calculating the discount factor is the same as the net present value or NPV formula. The formula is as follows. Factor is equal to 1 whole divided by 1 whole multiplied by 1 plus discount rate power period number. In period 6, which is year number 6, that we are discounting, the number in the formula would be as follows. Factor is equal to 1 whole divided by 1 whole multiplied by 1 plus 10% whole power 6, which is equal to 0.564. If the undiscounted cash flow in that period is $120,000, then to get the present value of that cash flow, we multiply it by the factor, which is 0.564, to arrive at $67,736.9. What is an annuity? The term annuity refers to an insurance contract issued and distributed by financial institutions with the intention of paying out invested funds in a fixed income stream in the future. Investors invest in or purchase annuities with monthly premiums of lump sum payments. The holding institutions issues a stream of payments in the future for a specified period of time or for the remainder of the annuitant's life. Annuities are mainly used for retirement purposes and help individuals address the risk of outliving their savings. How an annuity works. Annuities are designed to provide a steady cash flow for people during their retirement years and to alleviate the fears of outliving their assets. Since these assets may not be enough to sustain their standard of living, some investors may turn to an insurance company or other financial institution to purchase an annuity contract. Phases of annuity. An annuity goes through several different phases and periods. These are called, number 1, the accumulation phase, which is the period of time when an annuity is being funded and before payouts begin. Any money invested in the annuity grows on a tax-deferred basis during this stage. Number 2, the annuitization phase, which kicks in once payments commence. Immediate annuities. The immediate payment annuities begins paying immediately after the annuitant deposits a lump sum. Immediate annuities are often purchased by people of any age who have received a large lump sum of money, such as a settlement or a lottery win, and who prefer to exchange it for cash flows into the future. Deferred annuities. Deferred income annuities don't begin paying out after the initial investment. Instead, the client specified an age at which they would like to begin receiving payments from the insurance company. Deferred annuities are structured to grow on a tax-deferred basis and provide annuitants with guaranteed income that begins on a specified date. Fixed annuities versus variable annuities. Fixed annuities provide regular periodic payments to the annuitant, and variable annuities allow the owner to receive larger future payments if investments of the annuity fund do well and smaller payments if its investments do poorly, which provides for less stable cash flow than a fixed annuity but allows the annuitant to reap the benefits of strong returns from their fund's investments. Who regulates the annuities? Annuity products are regulated by the Securities and Exchange Commission or SEC and the Financial Industry Regulatory Authority or FINRA. Agents or brokers selling annuities need to hold a state-issued life insurance license and also a securities license in the case of variable annuities. These agents or brokers typically earn a commission based on the notional value of the annuity contract. Surrender period. Annuities usually have a surrender period. Annuitant cannot make withdrawals during this time, which may span several years, without paying a surrender charge or fees. Investors must consider their financial requirements during this time period. For example, if a major event requires significant amounts of cash, such as wedding, then it might be a good idea to evaluate whether the investor can afford to make requisite annuity payments. Income rider, fixed income. Contracts also have an income rider that ensures a fixed income after the annuity kicks in. There are two questions that investors should ask when they consider income riders. Number one, at what age do they need the income? Depending on the duration of the annuity, the payment terms and interest rates may vary. Number two, what are the fees associated with the income rider? While there are some organizations that offer the income rider free of the charge, most have fees associated with this service. The time value of money. To sum up, the time value of money, money that you have right now will be worth more over time. So $1 now will be worth more than $1 in a year from now. Future value. How much money put in the bank today will turn into at some point in the future with the interest. One needs to know three things. Number one, present value. Number two, interest rate. And number three, time period of investment. The formula to find future value is FV is equal to PV whole multiplied by 1 plus R whole power n. In this formula, PV is equal to the present value, R is equal to the interest rate one will earn on the money, N is equal to number of periods, and FV is equal to future value. Future value example. Let's assume that TAM puts $1,000 in the bank for 5 years at 5% interest. Future value is equal to present value whole multiplied by 1 plus R whole power n. Here in the example, present value is equal to 1000, interest rate is equal to 5%, and terms or n is equal to 5 years. Future value will equal to 1000 whole multiplied by 1 plus 0.05 whole power 5, which will be equal to 1000 multiplied by 1.2762, and that will be equal to $1,276.2. Present value. Present value is how much you need to save today to have a specific amount at some point in the future. Here is the formula for present value. Present value is equal to future value whole divided by 1 plus R whole power n. In this equation, PV is equal to the present value, R is equal to the interest rate one will earn on the money, N is the number of periods, and FV is equal to future value. Present value example. If you need $2,000 in 10 years for 5%, let's find out how much you need to invest today. Future value is equal to 2000 in this example, interest rate is 5%, N is equal to 10 years. Let's put the amount in the formula. Present value will be equal to $2,000 whole divided by 1.05 whole power 10, which will be equal to 2000 divided by 1.6289, which further will be equal to 1227.8. Ordinary annuity versus annuity due. What if you do not have the $1227.8 to invest today? You can still reach the target of $2,000 in 10 years by depositing an amount each year in the same amount, earning him 5% interest annually. If you deposit equal amounts into the account each year, that amount is called an annuity. If the amount deposited is different each year, we can call that a scheme of mixed cash flows. If the annuities are deposited at the end of the year or at the end of the period, it is called an ordinary annuity. If the annuities are deposited at the start of the year or at the beginning of the period, it is called annuity due. How to calculate future value of an annuity? Formula for the future value of an annuity, which is how much a stream of $8 invested each year at R interest rate will be worth in N years. Here's what it looks like for ordinary annuity. FV ordinary annuity is equal to A whole multiplied by 1 plus R whole power N minus 1 whole divided by R. For an annuity due, it looks like this. FV annuity due is equal to A whole multiplied by 1 plus R whole power n minus 1 whole divided by R whole multiplied by 1 plus R. Criticism of annuities. One criticism of annuities is that they are liquid. Deposits into annuity contracts are typically locked up for a period of time known as the surrender period, where the annuitant would incur a penalty if all or part of that money were touched. Number two, these periods can last anywhere from 2 to more than 10 years, depending on the particular product. Surrender fees can start out at 10% or more, and the penalty typically declines annually over the surrender period. Annuities versus life insurance. Life insurance companies and investment companies are the two primary types of financial institutions offering annuity products. For life insurance companies, annuities are a natural hedge for their insurance products. Life insurance is bought to deal with mortality risk, which is the risk of dying prematurely. Policyholders pay an annual premium to the insurance company who will pay out a lump sum upon their death. Annuities, on the other hand, deal with longevity risk or the risk of outliving one's assets. The risk to the issuer of annuity is that annuity holders will survive to outlive their initial investment. Annuity issuers may hedge longevity risk by selling annuities to customers with a higher risk of premature death. What is an annuity fund? An annuity fund is the investment portfolio in which an annuity holder funds are invested. The annuity fund earns returns which correlate to the payout that an annuity holder receives. When an individual buys an annuity from an insurance company, they pay a premium. The premium is invested by the insurance company into an investment vehicle that contains stocks, bonds, and other securities, which is the annuity fund. What is insurance? Insurance is a contract represented by a policy in which an individual or entity receives financial protection or reimbursement against losses from an insurance company. The company pools clients' risks to make payments more affordable for the insured. Insurance policies are used to hedge against the risk of financial losses, both big and small, that may result from damage to the insured or her property, or from liability for damage or injury caused to a third party. Three determinants of the policy. In order to select the best policy for you or your family, it is important to pay attention to the three critical components of most insurance policies. Number one, the deductible. Number two, the premium. And number three, policy limit. Deductibles. The deductible is a specific amount the policyholder must pay out of pocket before the insurer pays a claim. Deductibles serve as deterrents to large volumes of small and insignificant claims. Deductibles can apply per policy or per claim depending on the insurer and the type of policy. Policies with very high deductibles are typically less expensive because the high out-of-pocket expense generally results in fewer small claims. Premium. A policy's premium is its price, typically expressed as a monthly cost. The premium is determined by the insurer based on your and your business's risk profile, which may include creditworthiness. Policy limit. The policy limit is the maximum amount an insurer will pay under a policy for a covered loss. Maximums may be set per period, which can be annual or policy term, per loss or injury, or over the life of the policy, also known as the lifetime maximum. Typically, higher limits carry higher premiums. For a general life insurance policy, the maximum amount the insurer will pay is referred to as the face value, which is the amount paid to a beneficiary upon the death of the insured. Insurance companies. Insurance companies may sell any combination of insurance types but are often classified into three groups. Number one, life insurance companies, which sells life insurance, annuities, and pensioners products and bear similarities to asset management businesses. Number two, non-life or property or casualty insurance companies, which sells other types of insurance. Number three, health insurance companies, which sometimes sells life insurance or employee benefits as well. General insurance companies. General insurance companies can be further divided into these subcategories. Number one, standard lines, and number two, excess lines. In most countries, life and non-life insurers are subject to different regulatory regimes and different tax and accounting rules. The main reason for the distinction between the two types of company is that life, annuity, and pension business is very long-term in nature. Coverage for life insurance or a pension can cover risk over many decades. By contrast, non-life insurance usually covers a shorter period such as 1 year. Mutual versus proprietary insurance companies. Insurance companies are generally classified as either mutual or proprietary companies. Mutual companies are owned by the policy holders, whereas proprietary insurance companies are owned by the shareholders who may or may not own policies. Reinsurance companies. Reinsurance companies are insurance companies that sell policies to other insurance companies, allowing them to reduce their risks and protect themselves from substantial losses. The reinsurance market is dominated by a few very large companies with huge reserves. A reinsurer may also be a direct writer of insurance risk as well. Captive insurance companies. Captive insurance companies may be defined as limited purpose insurance companies established with the specific objective of financing risk emanating from their parent group or groups. This definition can sometimes be extended to include some of the risks of the parent company's customer. In short, It is an in-house self-insurance vehicle. Captive as component of risk management. Captives are becoming an increasingly important component of the risk management and risk financing strategy of their parents. This can be understood against the following backgrounds. Number one, heavy and increasing premium costs in almost every line of coverage. Number two, difficulties in insuring certain types of virtuous risk. Number three, differential coverage standards in various parts of the world. Number four, rating structures which reflect market trends rather than individual loss experience. Number five, insufficient credit for deductibles or loss control efforts. Insurance consultants. There are also companies known as insurance consultants. Like a mortgage broker, these companies are paid a fee by the customer to shop around for the best insurance policy among many companies. However, with insurance brokers, the fee is usually paid in the form of commission from the insurer that is selected rather than directly from the client. Neither insurance consultants nor insurance brokers are insurance companies, and no risks are transferred to them in insurance transactions. Financial stability and rating. The financial stability and strength of an insurance company should be a major consideration when buying an insurance contract. Insurance companies are rated by various agencies such as AM Best. The rating includes the company's financial strength, which measures its ability to pay claims. It also rates financial instruments issued by the insurance company, such as bonds, notes, and securitization products. Credit. Credit is defined as a contract agreement in which a borrower receives a sum of money or something of value and repays the lender at a later date, generally with interest. There are many different forms of credit. The most popular form is bank credit or financial credit. This kind of credit includes car loans, mortgages, signature loans, and lines of credit. Buying on credit. The most common form of buying on credit today is the use of credit cards. This introduces an intermediary to the credit agreement. The bank that issued the card repays the merchant in full and extends credit to the buyer, who may repay the bank over time while incurring interest charges in the meantime. Credit in financial accounting. In the context of personal banking or financial accounting, a credit is an entry recording a sum that has been received. Traditionally, credit or deposits appear on the right-hand side of the checking account register, and debits or money spent appear on the left. Depreciation. A detailed lesson number 14 on the topic has already been delivered under the subject of basic concepts of accounting, which can be viewed on the channel. Financial statements. A detailed lesson number 9, 10 and 11 on the financial statements, which are income statement, balance sheet and cash flow statement respectively, has already been delivered under the subject of basic concepts of accounting, which can be viewed on the channel. Dear viewers, you are watching topics of the business mathematics, some important terms and some important formulas on the topic. For detailed lecture, please keep on watching YouTube channel ETV 786 and don't forget to view, like, share and comment the videos and subscribe the channel to view upcoming lectures. Bye bye till the next show.